Thanks very much, Mark, Chuck, and Bob, for a great level set on those critical programs. We're going to come back in the final session to discuss the broader retirement security picture and how these programs fit in. But first, we're really pleased to have Rick Edelman here with us today. Rick is the founder and executive chairman of Edelman Financial Services, and he's the host of the Rick Edelman Radio Show. Rick is a highly acclaimed financial advisor, and he has dedicated most of his career to helping everyday people learn about personal finance. He's a New York Times bestselling author and also has a PBS special on retirement planning. I'd be remiss not to mention that Rick deserves much of the credit for why we are all here today. He's a co-founder of the campaign and continues to be one of its driving forces. It's really exciting to have him here in person to share with you all some thoughts about what he wishes he knew at age 25. Though knowing Rick, he probably did know all of this at age 25, so our title for the session might be a little bit inaccurate. Nonetheless, Rick's going to share some of his key insights, and then we'll leave time for a few questions. Rick?
Good afternoon, everybody. Are you thoroughly demoralized? I am, which is why we're here today. And I'm going to blow through, here's the good news and bad news. Bad news is I have 45 slides. The good news is I've only got 10 minutes to give them to you. So we're gonna jump right into it. And I'm going to speak to you really at your personal level here. I'm going to ignore the fact, for the moment at least, that you're a staffer here on Capitol Hill. I'll talk about that in a second. But you're all facing the same stuff, and that is the need to pay attention to your own personal finances. Too often we spend energy on our careers, making sure everything is there perfect, and when we think about long-term planning, we're usually thinking about Friday. So we need to look at it a little bit different. I want to make sure that you understand all the different reasons that you need to engage in financial planning. Number one is to build cash reserves, to be able to have money, to be able to deal with unexpected expenses as they come up, from cars breaking down to your sister unexpectedly getting married and you got to buy a dress, or you got to fly out to the ceremony, or what have you. And dealing with debts. Raise your hand if you have any debts. Anybody have student loan debts? Yeah, it's $1.5 trillion now. We owe more nationally to student loans than we do to credit cards. So we've got to deal with getting rid of our debts. We've got to deal with the cost of raising children. The USDA says it costs $250,000 to raise a child from 0 to age 17. $250,000. Guess what happens when they hit age 17? They go to college. We don't even want to talk about that. Oh, yes, we do, because we know the incredible cost of going to college today. The statistics are really rather astonishing. The average cost of college is well over $100,000, and it takes now 6 years to graduate. Less than half of students do, and they're still saddled with the student loan debt they accumulated. And half of the people in this country are women, and that means their mom and dad of those daughters have to pay for the wedding. The average national cost is $40,000. In New York City, it's $80,000. I keep telling my clients to have sons, not daughters, and only half of them listen to me. We all want to buy homes. We all want to retire in financial security and comfort. We need to take care of our aging parents, and that's part of the Social Security crisis. My mom is 91. And she's getting a hell of a deal from Social Security because she should have been dead 30 years ago. And she keeps going, which is also a bit of a nuisance because I'm still waiting for my inheritance. And so estate planning is a big issue as well. Aretha Franklin, who just passed, the news came out this morning that she died without a will. $80 million estate, and there's total turmoil because the family doesn't know who the heirs are. It's going to be resolved by the courts and lawyers. It's going to take decades, and the family will lose a third of the money to legal fees. So we've got to deal with estate planning issues for ourselves and our families. So that's the overview of what we've got to accomplish in the field of personal financial planning. It isn't something that rich people do. It isn't something that old people do. It is something that everybody needs to tend to over the age of 18, because at the age of 18, I don't know if you noticed this, when you got out of high school, they stamped adult on your forehead, and you now have legal rights and legal responsibilities that you've got to tend to. We tend not to pay attention to a lot of this stuff because of physiology and psychology. Our brains are designed to trick us into making bad financial and investment decisions. There's a whole field of behavioral finance. It won the Nobel Prize last year in economics. It was actually the second time it won the Nobel Prize. And we have, in my firm, an entire 2-hour seminar on the subject. You'll see a PBS special later this fall on the subject of mind over money. And it's the basis for why many people fail financially. The Nobel Prize-winning research was first by Kahneman and Smith in '02 and Richard Thaler last year in 2017, and it all comes down to this slide. You tell me which of these two horizontal lines is longer. You know the answer to this. You saw it in second grade. We all know that the slides are equal in length. It doesn't matter that you know it. When you look at those, you'd swear that one of them is longer than the other. And it's simply because of the way our brains work. And all of these psychological biases, there are 24 of them, cause us to make really bad financial decisions. And I'm going to show you a couple of little quick steps on how you can take all this science that has been created in the laboratories and apply it to the decision making in your own personal life. And I'm going to limit this conversation to investments. And we've got a big, huge conversation in the field of personal finance, as I've just mentioned, but we're going to talk about the very tangible element of the incredible importance for you to save some of your income. We're not going to get into a whole lot of conversation of how much you should be saving, but I'm going to show you where you should be saving it. And there's 4 simple steps. What I'm about to show you is how we manage money for our clients. We're now one of the largest investment management firms in the nation. We have $22 billion in assets under management for 36,000 families all across the country. And what I'm going to show you is how we manage money for all of our clients. You don't have to do this with us. That's not my point. What I'm about to show you, you can do anywhere. You can do it on your own. You can do it with any financial advisor of your choice. You can apply this within the Thrift savings plan, which we're going to talk about as well here today. 4 simple steps. Number 1 is to establish diversification. We know that investing is risky. The problem is there's no such thing as a safe investment. Every investment has one type of risk or another. And so the way we minimize risk is 12 eggs in 12 baskets. Don't highly concentrate your money. Don't put all of your money into one thing. And let me illustrate for you the importance of this. We took a look at the 16 major asset classes and market sectors over the past 10 years. And back in 2008, 10 years ago, we ranked them from the very best at the top to the very worst at the bottom. And here's how they performed. Each color box is a different asset class. You know, stocks, bonds, government securities, real estate, gold, foreign currencies, commodities, timber, oil and gas, on and on and on. Guess how these asset classes performed over the 10-year period. Here's how they did. Do you see the pattern? If you do, you need a psychologist, like I was talking about. There's obviously no pattern here. It's incredibly random, and that's the point. Nobody knows what's going to happen next in the financial markets. And anybody who claims to know is either lying or not an expert. We'll just leave it at that. Let me put it to you another way. Go back over the last 10 years to those 16 asset classes. If you invested in all of them equally for the whole 10 years, you would have earned about 7% per year. That's a pretty good return. But if you missed the 3 that made the most money over the 10 years, the 3 each year, your return would not have been 7.2, it would have been only 3.3. More than half of the returns of the last 10 years were provided by the top 3 assets. And that's the point. If you can't pick what the top 3 are going to be, don't bother trying. We don't know, and we don't try to pick. We invest in all of them. It's like, instead of buying a ticket on a racehorse, we buy on every racehorse. And then we own the track besides. We don't care who wins the race, because we're going to be equally invested across the board, and it solves the problem. Now, I'm not suggesting you just have an equal portfolio of stocks and bonds. That's a little too simplistic. This is more illustrative of the kind of diversification that you can obtain in a diversified portfolio. It's got, in the world of stocks, large cap, mid cap, small cap, growth and value, US and foreign. In bonds, it's government and corporate. It's short-term, intermediate, and long-term, high quality and high yield. It's got US versus foreign. There's real estate, natural resources like oil and gas, precious metals, minerals. You've got exponential technologies. That black dot in the middle is cash. Cash is an asset class. This might not be an asset allocation that makes sense for you. Maybe your asset allocation will look like this, or this, or this. In other words, the kind of portfolio you create has to be based on your situation. How much money do you have? How much money are you saving? How long is it going to be remaining invested? How soon do you need to generate income? What's your attitude about risk? How much volatility are you willing to tolerate? We have some nifty tools at our website. There's a lot of nifty tools available on the web to help you figure out what an asset allocation ought to look like. And the key is to build one. That's step number one. Step number two is to do whatever it is you're going to do for a really long time. You tell me, what are the two things the stock market does? What do prices do? There are only two things they do. What are they? They go up and they go down, right? Do we all agree with that? Well, it's wrong. That's not how the stock market works. If the only thing the stock market ever did was go up and down, nobody would ever invest in the stock market. That'd be like playing with a yo-yo. It's not how it works. Instead, the way it works is think of playing with a yo-yo while you're climbing a hill. The highs are at ever higher points, and the lows are at ever lower points. In other words, this is the performance of the stock market. This chart shows you the performance of the S&P since 1949. And as you can see, when the market is rising, it rises a huge amount for a really long time. But when it falls, it only falls a little bit for a short period. In other words, it goes up 7, down 2, up 5, down 1, up 4, down 3. And it's because of that that people are discovering that it's possible to earn a lot of money in the stock market, but you've got to be invested for a really long time to enjoy that benefit. And so the key is to build that diversified portfolio and leave it there for a really long time, which takes us to point number 3, which is to engage rebalancing. This is perhaps the most important investment management advice that I can give you, and it's the one that the vast majority of Americans never do. Let's say that we began, to illustrate the point, with a portfolio of 4 assets, equal split: stocks, bonds, government securities, and cash. Which do you think is likely to make the most money over a period of time of these 4? Which of these 4 asset classes? Stocks. Right, reasonable guess. Historically, stocks have always made more money than everything else. Past performance is no guarantee of future results. Any assertion to the contrary is a federal offense. But we have to assume something, and so we'll assume that stocks are going to do well in the future. Look what happens if that's true. In the future, because stocks grow faster than everything else, they eventually become a bigger piece of the pie than everything else. And all of a sudden, you're not diversified. You are now highly concentrated. And if that were you, and you're 65 in 2007, you got a problem, because the market's about to crash 50% over 18 months, and you're not going to retire like you thought. And so what we've got to do is rebalance the portfolio to bring it back to the original diversification. How do we do that? What do we have to do to have our portfolio go from this back to that? We have to sell some of the stock, right? Because there's too much of it. And we have to buy some of the bonds and some of the cash, right? Because there's not enough of it. In other words, we have to sell the asset that made the most money to buy the asset that made the least. We have to sell the winner and buy the loser. Who's willing to do that? It's counterintuitive, isn't it? Can you imagine going home from work and saying to your spouse when you get home, "Hey, honey, you know that stock we bought? We made a fortune. I just sold it. And that dog where we lost a ton, I loaded up." Can you imagine a stockbroker trying to pitch to you a 1-star fund instead of a 5-star fund? And that's the point. Psychologically, we love to invest when prices are high. And we love to sell when prices are low. In 2007, when the market was at an all-time high, investors were throwing money at the market. And by 2009, when the market hit the low of 6,700 on the Dow, people were selling like crazy. They bought high, they sold low, and then they complained that the market's rigged. This is investor psychology. This is behavioral finance and why we've got to overcome it. And that is exactly what rebalancing does for you. It prevents you from buying more of the very asset you should be selling and getting you to buy the assets that you ought to be buying as opposed to the one that's the opposite. And our final 4th step is to keep costs low, because the more you spend in investing, the less you get to retain. The average annual cost of mutual funds in this country is 0.62% per year. That is the price that mutual fund investors are paying on average in this country. Contrast that to exchange-traded funds. They're 2/3 cheaper. Why on earth is anybody buying antiquated retail mutual funds when you can obtain the same diversification, often with the same managers, buying the same portfolios, and saving 2/3 of the price? And oh, by the way, don't assume you have to do this on your own. In our firm, our clients are paying 0.25. The reason I say this is not to brag about our firm. I don't think we're terribly unusual for many financial advisors in the country. The point is, don't assume that financial advisors are going to throw you into incredibly risky or unusually expensive investments. Not always the case at all. So you can summarize this very simply. Diversify, focus long-term, rebalance, and keep your costs low. One final thing I want to mention, and then we'll do some Q&A, and that's your thrift savings plan. We asked the question earlier, how many of you are participating in the plan, and most of the hands didn't go up. You're supposed to understand you should have raised your hand even if it was a lie, just so you'd look good to everybody else in the room. So we're going to assume you are participating in your thrift savings plan, and if you're not, you need to. You need to contribute to the maximum pre-tax you can, at the very least 5% of your pay. For as Mary Beth described, you need to, and Jamie did as well, you need to make sure you get the full match. There is nowhere else you can double your money without any risk. And that's what you get in the thrift savings plan. You also have the benefit that the thrift savings plan is the cheapest retirement plan in the country. Two benefits I can't provide my clients unless they're working for the federal government. So here's the real key, is to join the plan, throw as much money into it as you can, a minimum of 5% of your pay. And now the second question becomes, where should you invest the money? You have how many choices in the thrift plan? Anybody know? There are 5, plus the L funds. We don't count them because they're just combinations of the other 5, right? So you have 5 choices. Which of those 5 should you be using? Here's the answer. CSI, 40-40-20. 40% of your money into C, 40% into S, 20% into I. In other words, all of it into stocks. None of it into G, none of it into F, because those are bonds or fixed income accounts. Why am I telling you to ignore? I just said a moment ago, diversify. I told you to do that, right? And now I'm saying don't diversify, don't buy the bonds, don't buy the fixed, put it all into stocks. Why am I telling you to do that? Contradictory to what I said a minute ago. There are 2 reasons. The first reason is you have an incredibly long period of time in your thrift plan. You're not going to touch the money, looking at the ages here, you're not as old as me, you're not going to touch the money for 20, 30, 40 years, and as we've seen, time means stocks win. So that's the first reason. Second reason, there are 2 ways to diversify. One is to buy a lot of different kinds of assets, 12 eggs in 12 baskets. That's one way to diversify. This is the one most people think of, is 12 eggs, 12 baskets. But there's another way to diversify. It's called diversifying not by asset, but by diversifying by time. In other words, nobody makes a lump sum contribution into the thrift plan. Instead, how do you put money into the plan? With every paycheck, right? How often do you get paid? Once a month, right? So picture this. Picture that you're getting a paycheck, and out of that paycheck, you put $100 into the thrift plan. And let's pretend that the fund you're buying is $10 a share. Next month, you get another paycheck, and you get another $100 that you put into the plan. And you're taking the $100 and you're putting it into the very same fund that you did last month. Only this time, there's been a market crash, and the fund is only worth $5. You tell me, when the fund was $10 a share, how many shares did you buy? This is a math quiz. How many shares? 10 shares. When the fund was $5 a share, how many shares did you buy? 20 shares. So you tell me, what's the average price of the fund? You know, you bought some at $10, you bought some at $5, so what's the average price? $7.50? Follow me on this. What's 10 plus 20? It's another math question. What's 10 plus 20? 30. What's 100 plus 100? You've invested $200. You own a total of 30 shares. Divide that out. And what's the answer? What's 200 divided by 30? 660, 666. Wait a minute, you said 750 was the average price. But I'm showing you that the average cost is 667. Do you understand what I'm talking about? It's called dollar cost averaging. And the simple way the mathematics work is that dollar cost averaging acknowledges a very important principle to investment management. Do you know what that principle is? It's the following statement. When it comes to investing money, we are all idiots. When is the time you should buy? Low, right? We should buy when prices are low. When the stock was 10 bucks a share, dollar cost averaging said, you idiot, you're not supposed to be buying. The price is high at 10 bucks, so I'm only going to let you buy 10. But when it's 5 bucks a share, the price is low, you idiot, and I want you to buy a lot, so I'm going to get you 20. You end up with a cost-efficient methodology of accumulating the shares, and the only thing you've got to do to make it work is to put in the 100 bucks with every paycheck and let the math do it all by itself. You're right, the average price is $750, but you're also right that the average cost is $667. Now think about that. If the average cost is always lower than the average price, can you imagine how much money you're going to make over the course of your career? And that is why I want you to invest in the most volatile investment you can find. It wouldn't do you any good to dollar cost average into a bank account where the price is always $1. You need to invest where there are wild swings in value so that you can take advantage of buying lots of shares at low prices and relatively few shares at higher prices. And where do you find massive volatility and unpredictability? The stock market. And that's why I want you to put your money into CSI 40-40-20 in the stock market. Do that for 30 years, and you're going to be glad you attended today. There's an awful lot of other information and content that is available to you. I've written 9 books myself. We have our first children's book coming out in November for 3 to 5-year-olds. It's never too early to start learning about money. And we've got a huge amount of information through the Bipartisan Center's partnership with Edelman Financial and all of our other partner organizations at fundingourfuture.us that we invite you to take advantage of. I'm just really thrilled that you're here. And before we go to Q&A, I just want to mention one thing. In fact, I'm going to wait. I'm going to put you in suspense. We'll do that in my final going away message. First, we're going to jump right into Q&A. So we've got microphones, I think, there and there. So if anybody has a question on any subject in the field of personal finances, happy to take them. There's a question right here. Wait for the mic so we can get that on tape.
Hi. Housing is a major way that people accumulate wealth in this country. Like, what's the best way to know if you're over or under investing in housing?
So you're right, real estate, I'm not going to call it housing, real estate is a major asset class. And there are lots of ways to make money, and real estate is clearly one of them. I'm going to break out real estate between personal residence and investment real estate. Your residence is not an investment. Your residence is a place to live. You buy it because it's close to schools, work, and shopping, and far from relatives, and it meets your needs and everything you need to accomplish. So the fact that your home rises in value over time is serendipity. Don't count on it, don't expect it, it's likely to happen, but leave it at that. Rental real estate, investment real estate is a whole nother beast, and clearly an element of a diversified portfolio that you should engage in. The problem with real estate is that it takes a lot of money. It is highly concentrated because most folks don't have enough money to buy lots of pieces of property the way you can buy lots of mutual funds. Nobody ever calls me on the phone at 3 a.m. because something went wrong with their mutual fund. So it's a nuisance, it's a pain to be a real estate owner, to be a landlord, so you need to factor all that in. We do recommend that clients have 3 to 5% of assets in real estate. You can argue 10. Real estate investors will have the entire portfolios in real estate. I'm personally not a fan of that from a diversification liquidity perspective, but real estate is a perfectly fine asset class. 2 things to keep in mind. The returns on real estate over the last 100 years are nowhere near as high as the returns on stocks. So do not think you're going to get richer in real estate than in stocks. The reason it might appear you do is the second reason, and that's leverage. Most real estate investors don't pay cash for the real estate. They borrow the money to get mortgages on it. And it's the fact that they invested $100,000 to buy $1 million property that creates the illusion of a big return. You can do the same thing with stocks. You can margin your stock account and have the same benefit. So yes, real estate belongs in the portfolio. Don't think you're going to do as well in it as you will in stocks on an equal risk-to-risk parity. But yes, you should do that. And yes, you should consider home ownership only if you're going to keep the home for 7 to 10 years or more, because the incredible cost of home ownership relative to renting. So don't take the attitude, oh, I'm throwing my money away on rent. No, you're not. You know, any more than you're throwing your money away on a car. I mean, we all know the cars fall in value, but we buy them anyway. They have a lifestyle service, and so does where you live. So home ownership and rental property are two different things. Yes? Oh, we need to turn the mic on. I can. Well, I'll repeat it if that doesn't work.
Okay, well, either way. Oh, here we go. So I was going to ask originally, as a federal employee who makes like $40K, and in DC where your living expenses are insane, should we be worrying about like investment apps or Roth IRAs or TIA Thrift or all these different things? Or am I understanding correctly that you're saying just use not just use it, but the TSP is like the best way to go until we're making something that we can live off of?
So
is that more or less what you're saying?
Yes, I understand your question. Great. It was really well said. I'm going to give you the 4-step process for creating wealth in America. Step number 1 is to join the Thrift Savings Plan to the maximum you can pre-tax. That's step number 1. Step number 2, pay off debts. Now, a lot of people find that funny that I inverted it that way, because a lot of people think you're supposed to pay off your debts first. You got 18% to Visa, get rid of that debt before you start saving. Why do I say save first? Because, you ready for this? You're going to have debt your entire life. If you wait to pay off your debt before you start saving, you will never save. So, am I freaking you out, Mary Beth? Are you with me on that? You know, so it's really important you do this, because a lot of folks think the opposite. Oh, you got to get rid of the debts. Well, of course you do, but not to the point where you're delaying your savings. So join the plan at work here, the Thrift Plan, and then when you get that underway, focus on getting rid of those debts, particularly credit card debts, personal debts. If you've got car loans, mortgage loans, or student loans, just make the regular monthly payment. Don't make extra payments. Don't try to accelerate the payoff. Just make the regular payment program and leave it at that. Step number 3, build cash reserves. You need to have 12 to 24 months worth of spending in cash. 12 to 24 months. That's not 12 to 24 months of income. I mean of your true spending needs. In other words, if you lost your job tomorrow, doesn't really happen on Capitol Hill, does it? But if you've got some kind of major financial crisis, maybe a family member has a crisis, you need to help them, or who knows what, you've got a year or 2 to tide yourself over before you had to tap into other resources. So a year to 2 of cash reserves. And then finally, step number 4, saving elsewhere, which is the question you raised. Saving in an IRA on the outside, saving in a brokerage account or an investment account to build wealth toward buying a home, toward raising children, to saving for college for those children, to other needs that are going on in life, and so on and so forth, including all important Friday night. So that's the 4-step process.
And we have time for one more question. Here you go.
Hi. Rick, Ted Knudsen, contributor to Forbes. We've known each other for years. We've disagreed before. We're going to disagree right now. That when you talk about investments, I mean, overall, what you're really talking about for retirement is standard of living. For standard of living, there are 2 things involved: income and outgo. You're a renter. You have a lot more outgo than if you own your own home. So isn't...
No, I don't agree with that. I don't necessarily agree with that, and I'll tell you why. Homeowners will do things in their homes that renters never would. Homeowners will decorate, they will paint, they will wallpaper, they will build draperies, they'll install AV systems, they'll build fences, they'll engage in massive landscaping. They spend huge amounts of money in maintenance and repairs and property taxes that renters never have to incur. Homeowners have to decide which of the 2 of you is going to stay home from work because the plumber's coming. The renter calls the landlord and says it's your problem and leaves. So you're also dealing with the real estate commission cost of the property. And people say, well, it didn't cost me anything to buy the house because the seller paid for it. Well, one day you're going to be the seller, and here's one of the biggest crimes of all. You know what the commission is when you're dealing with real estate? What's the commission when you typically pay a realtor? 6%. Of what? Isn't that ridiculous? Nobody in any other business charges you a percentage of the sale price. They always charge you a percentage of the purchase price. Think about it when you buy a stock or a mutual fund or a car. You pay the commission on the value of it at the time of purchase. But they don't do that in real estate. You buy a house for 500 grand and sell it later for $1 million. You're paying 6% of the $1 million, not of the 500,000. Really, it's a 12% commission, not a 6% commission. Renters don't have to incur any of that. Renters can also get up and leave whenever they feel like it. Homeowners don't have that luxury. So this is why I can argue, and in fact there are a few million people in New York City who agree with me, that homeownership is foolish. And you have people, Ed Koch, the former mayor of New York, was famous for never having owned a home. And a lot of New Yorkers feel that same way, people in urban areas. So don't be so quick to buy a home, especially if your life is unstable. Because if you don't know where you're going to be in 5 years, you don't know if you're going to have a spouse, you're going to have kids, you don't know where your job's going to be, buying a home today can set you up for a financial problem that as renting you don't have to worry about. One final comment, because Shay's going to throw me off. I said I'd get it to you. This whole conversation today, although I really wanted to talk with you a lot about your own personal finances and the need for you to become successful individually, you have a unique role in American society. And I'm thrilled that you're here today because I want to emphasize this with you. You are a key member of the congressional staff here on Capitol Hill. You have the eyes and ears of your member of Congress and the Senate. And as a result of this, we need to recognize the incredible challenge we are facing as a country with Social Security and Medicare. I want to make sure you really fully understand the bluntness of the situation. Current law says, and I'm emphasizing this because I believe many members of Congress don't realize this because they weren't in office in 1983 when the law was last changed. The current law says that starting in 2034, some people say it's 2032, current Social Security retirement benefits will be cut 23% across the board. If Congress takes no action, the current law mandates a 23% cut in benefits for all retirees equally. This will create an economic crisis for millions of retirees of unprecedented proportion. With more than half of today's retirees receiving more than half of their incomes from Social Security, and that average check being about $1,200 a month, a 23% cut down to about $900 a month will cause millions of people to lose their homes. They'll be unable to buy medicine. And just imagine the economic impact on this country, and imagine what Congress will have to do about it with massive tax increases to come up with the cash to prevent that from happening, creating a massive problem for everyone younger still in the workforce, meaning you, in just 14 years. We need to get this fixed. We need to get this addressed. Just like we did in 1983, proving it can be done, we need to do it again. And we need to do it really, really fast because the longer we wait, the more difficult it becomes to fix. And that's the messaging that you're hearing today. So I implore you to please address personal finances for yourself and your family, and please use your unique role here on Capitol Hill to discuss this with your member of Congress so that we can begin to figure out how to solve the issue. The solutions are readily available. There's been a huge amount of brain power applied to this. Now all we need is Congress to take action to protect the nation from what is inevitably otherwise coming. Thank you so much for your time here today. I really, really appreciate it very much. Thank you so much.